Most people hear about the Fed funds rate and think it is just an interest rate, just a number that goes up or down. But in reality, it is much more than that. It is the foundation of the entire financial system. The Fed funds rate is the rate at which banks lend money to each other overnight. It sounds simple, but this rate sits at the very core of how money moves through the system. Because banks rely on short-term funding to operate, this rate influences the cost of money across the entire economy. When it moves, everything connected to money starts to adjust. When the Fed raises rates, borrowing becomes more expensive. Loans, mortgages, and credit all begin to cost more. This slows down spending, investment, and risk-taking. When the Fed cuts rates, the opposite happens. Money becomes cheaper, credit expands, risk-taking increases, and capital begins to move more freely through the system. But the Fed funds rate is not just about today, it acts as a reference point. A baseline. From this single rate, an entire structure of interest rates across the economy is built. Government bond yields, corporate borrowing costs, mortgage rates, and even stock market valuations are all influenced by where this rate sits and where it is expected to go. This is why markets react so strongly to even small changes in the Fed funds rate. Because a small shift at the foundation can ripple through the entire system. But here is where most people get it wrong. Markets do not wait for the Fed to move, they react to expectations. What matters is not just the current rate, but where it is going next. If markets expect higher rates, they begin tightening conditions immediately. If they expect lower rates, they begin easing before the Fed even acts. This is why the Fed funds rate is not just a number. It is a signal. A signal about the cost of money, the direction of policy, and the future path of liquidity. If you understand what the Fed funds rate really represents, you stop focusing on the number itself and start focusing on what it means for the system as a whole. And once you understand that, the next step is to understand what the Fed is actually watching when it sets this rate. Because the Fed is not reacting to one number. It is reacting to financial conditions. And that is what truly drives its decisions.